Walter pulled $1,000 from his retirement account, just $1,000, to fix the roof. His tax bracket was 12%, so he expected the tax to be about $120. Instead, that $1,000 withdrawal cost him $222 in tax, an effective rate of 22%, nearly double what his bracket said. Walter didn't make a mistake. He walked into something most retirees never see coming. It even has a name. They call it the tax torpedo. Here's the thing nobody tells you about Social Security. It can be taxed. And worse, the income you pull from other places can quietly drag your Social Security into being taxed too. Most people believe one of two things. Either that Social Security is always tax-free, it isn't, or that their tax bracket is their tax bracket. A dollar taxed at 12% costs 12 cents. For millions of retirees, both of those beliefs are wrong, and the gap between them is the torpedo. To understand it, you have to meet a number the IRS almost never says out loud: your provisional income. Provisional income is a special recipe. Take all your other income, your pension, your IRA withdrawals, even your tax-free muni-bond interest. Then add half of your Social Security benefit. That total is your provisional income, and it decides how much of your Social Security gets taxed. Here's how it works. There are two thresholds. For a single filer, below $25,000 of provisional income, none of your Social Security is taxed. Between $25,000 and $34,000, up to half of it becomes taxable. And above $34,000, up to 85% of your benefit is pulled into your taxable income. For a married couple, the lines are $32,000 and $44,000. Same idea, slightly higher. Now, here is the part that should make you angry. Those thresholds have not changed since the 1980s and 90s. They are not adjusted for inflation, ever. When they were written, almost no one was affected. Today, with decades of inflation, they catch ordinary middle-class retirees. The net was set low on purpose, and every year it quietly catches more people. So how does a $1,000 withdrawal get taxed at 22% in a 12% bracket? This is the heart of the torpedo. When Walter pulls an extra $1,000 from his traditional IRA, two things happen at once. First, that $1,000 is taxable, of course. But second, because it raised his provisional income, it also drags $850 of his Social Security into being taxed alongside it. So a $1,000 withdrawal doesn't add $1,000 to his taxable income. It adds $1,000 plus $850, $1,850. At his 12% bracket, the tax on $1,850 is $222. On a $1,000 withdrawal, 22%. That's the multiplier. In the 85% zone, every dollar you withdraw is taxed as if it were $1.85. 12% becomes 22. And if you happen to be in the 22% bracket, it becomes 41%. A retiree of modest means can face a higher marginal tax rate than a millionaire. Let's see the shape of it, because the shape is the whole story. Picture your marginal tax rate as you earn more. Normally, it's a staircase. It only steps up, gently, as you cross into higher brackets. But add Social Security to the picture, and a hill appears in the middle. As your provisional income climbs through the thresholds, your marginal rate rises into this bump. 18%, then 22, even 41. And then, once 85% of your Social Security is fully taxed, it falls back down again. That's why they call it a torpedo. It's a hump of punishingly high rates sitting right in the income range of a typical retiree. Climb into it without knowing, and you lose money you never had to. And here's the cruel irony of who it hits. The very low-income retiree never reaches the thresholds, so they're safe. The wealthy retiree blew past them long ago. Their Social Security is already fully taxed, so an extra dollar is just taxed normally. It's the person in the middle, the careful saver with a modest pension and a modest IRA, who sits right inside the hump. The torpedo is aimed at the middle class. Now, a trap inside the trap. Remember that provisional income includes tax-exempt interest. So the retiree who moved into municipal bonds to get tax-free income? That interest still counts. It still pushes Social Security into taxation. Tax-free, it turns out, isn't always free. So what can you actually do about it? You can't repeal the thresholds, but you can steer around them. First and most powerful, Roth. Withdrawals from a Roth account are tax-free, and they do not count in provisional income. A dollar from a Roth doesn't drag your Social Security into tax. For a retiree near the thresholds, Roth money is worth far more than the same dollar in a traditional IRA. Second, do your Roth conversions early. In the gap, years after you retire, but before you claim Social Security. In those low-income years, you can move money from traditional to Roth at low rates, shrinking the future IRA that would have fired the torpedo later. Third, if you're charitable and over 70 and a half, give directly from your IRA with a qualified charitable distribution. It satisfies your required minimum distribution without adding a cent to your provisional income. And fourth, think about the order and the timing of your withdrawals across the whole retirement, not just 1 year at a time. Sometimes taking a little more in a low year to avoid a spike in a high one saves thousands. Walter's roof still got fixed, but once he understood the torpedo, he changed where he pulled the next 1,000 from and kept the extra $100 the IRS would otherwise have taken. The tax torpedo isn't a scam or a loophole. It's just a quiet piece of arithmetic hidden in plain sight that turns a 12% bracket into a 22% reality for the people who can least afford the surprise. You can't see it on a tax bracket chart. You can only see it if someone shows you the hump. This video is for educational purposes only, not financial, tax, or legal advice. The thresholds are current federal figures. The dollar examples are illustrations, and your situation will differ. Please talk to a qualified tax professional before making withdrawal decisions in retirement. If this showed you something your tax bracket never did, subscribe. Every week, we uncover one financial blind spot that can quietly cost families thousands, sometimes tens of thousands, of dollars. And send this to someone who's retired and taking withdrawals. They may be sailing straight into the torpedo without ever knowing it was there.